Hi everyone, welcome to part 3 of my Apple stock analysis. So last time we left off after calculating enterprise value from free cash flow. So today we're going to calculate one other metric that's important called ROIC, and then I'm going to just wrap it up with kind of my framework for analyzing stocks. So ROIC is it's really a measure of how well a company generates value with its capital. So in other words, if you gave Apple management $100, are they going to turn that $100 into $110, $120, or on the flip side, are they going to turn that into $90? So in the first two cases, they're creating value, and that's good for shareholders. In the last case, they're destroying value, and you don't want that as a shareholder. So to me, I really use ROIC in conjunction with enterprise value to free cash flow. To me, it's like a litmus test of whether it's like a company that passes the bar of being a good company to invest, because if you have a company that doesn't generate value, then that's a no. So one thing to know is ROIC by itself is not it's not a valuation metric. So unlike enterprise value to free cash flow, which kind of tells you like how cheaply a company is trading at, ROIC, just because a company has a very good ROIC doesn't necessarily make it a good investment, because everyone, investors may already know that, and they've already priced that in, and the stock could be very expensive. So I'm going to dive right in. I've pre-filled this before the video, just in the interest of time, but I'm going to show you how to find ROIC on the statements. So the formula for ROIC is just NOPAT, which, if you remember, we went over that in part 1, divided by average invested capital. Okay. And invested capital sounds fancy, but it's just debt plus book equity. And you can find all these things on the balance sheet. So book equity is under liabilities right here, stockholders' equity. Okay, so 72282, that's what I put in for Q2. And debt, we went over this last time, but you just you just add the short-term debt under current liabilities to the long-term debt under non-current, right, to get total debt. So let's build in a few formulas. So on the numerator side, we need to know NOPAT, trailing 12 month, right? We look at everything in 12-month increments. And then let's calculate invested capital. All right, so we got these, we're ready to calculate ROIC. So ROIC is equal to NOPAT divided by the average invested capital. So that just means you need to take this quarter's plus the same time last quarter or last year, so Q2 of last year, right? And then you divide that by 2 to get the average. And voila, we have ROIC. So it looks like it's 29.4 this quarter. Why is this a value? Because we don't have data. So looks like Apple's ROIC is about 26 to 29%. So that means that if you gave Apple $100, they're turning it into $130. So it's they're definitely generating a lot of value. And if you think about, like, Apple can borrow at very cheap rates, right? So even let's say their cost of the invested capital is like 10%, So you do 29% minus 10%. So they're still making like 20% even after accounting for the cost of that capital. And that's really good. It's one of the higher ones that I've seen for sure. Okay, so like I said, ROIC is more of a litmus test. On its own, it doesn't mean very much. But here we can tell it's obviously Apple is a value generative company. And that's a great thing. So I'm going to wrap up. I'm going to go into the final part, so I'll share my basic framework for evaluating stocks. So why have we done all this work, right? So first I'll go into some subjective things. So when I look at a stock, the first thing I look at, I keep it pretty simple. Does the company create things that people want, that people value? Okay. And I find that, once a company has that down, that's like half the battle. That's half the battle of finding a good investment, is when you can find a company that creates something that people generally value. And so for Apple, personally, I think that's definitely the case, right? Like I use Apple products and I can't, kind of live without them. And you might disagree with me, but so this, for me, Apple checks the box here for sure. And the second one you probably heard of from other famous investors, like, does the company have a moat? What that means is that, does it have something that's hard to replicate? So if you're, like, you might sell toilet paper and that's something that people value, but it's pretty easy to, create toilet paper. There's not a lot of IP in creating like commodities, right? So in this case, Apple also checks the box, because I think the hardware and the software kind of together is very difficult to replicate, right? You can see like Android kind of like Google does the software side, but they don't really have the hardware part down. So like the integrated software hardware is something that I find it does like give Apple a moat. So that also checks the box. And finally, I think this is kind of the most important thing that people kind of miss, because the first two are kind of obvious. I think people who like live here in the U.S. They kind of know Apple products, right, and know what kind of value they bring. So the third one is why we did all this work. So enterprise value to free cash flow. This tells you how cheaply Apple is trading at, and this is telling us that Apple has a enterprise value to free cash flow of 29 times, and kind of around 30 times. So that means that, here's the way I think about it. So that means that if you invested in Apple, it'll take you about 29 years to make back your investment. If the assumption is Apple is generating the same amount of cash as it is today. So to me, 29 years, I have to wait 29 years. So that's a pretty long time. Obviously this is only looking at their historical cash flow generation. In the future, let's say if you think in a year, Apple is going to generate like 2 times what it's generating today, then this multiple is going to fall down from 30 to 15, right? But then you have to, so then you have to kind of think about the range of outcomes on Apple. What's like the most optimistic case, and kind of what is the downside, the pessimistic case, right? And then there's outcomes in between. So to me, like, because Apple has a moat, it definitely deserves a pretty high enterprise value to free cash flow multiple. But am I willing to wait 30 years to make back my investment at the current amount of cash they're generating? And do I think Apple is really going to be able to generate like a lot more cash? Well, naturally it will because of inflation. So because of inflation, Apple products are going to get more expensive over time. Therefore, because they make a margin, a pretty good margin on their products, they're going to generate more cash. But inflation is not like 10% a year. It's maybe just a few percent a year right now, right? And it's hard to imagine a scenario where that becomes so high that it's going to seriously decrease this multiple. And you'll kind of you'll kind of, when you look at other companies, you kind of get a sense of what's like a reasonable multiple. So later on, I might, look at Google or Microsoft or Amazon, and then we can compare the multiples and see, are these reasonable, or are they kind of very expensive or cheap? So, for example, if like Amazon, Google, and Facebook have like 50-time multiples, then maybe Apple is cheap in comparison, right? So it's all kind of relative. And the interesting thing about investing is that I can look at this set of facts. Someone else can look at the exact same set of facts. In fact, they will, because these all come from their public financials. And we can come to completely different conclusions. So someone may look at this and go, well, I think Apple's going to, grow fast, and this multiple will come down, and it's a great buy right now. And someone may come up with like the opposite conclusion, right? Saying that it's like very overvalued. So that's kind of the secret sauce in investing. A lot of it is more art than science. And finally, I talked about the litmus test of ROIC, making sure that a company has positive ROIC after you account for their cost of capital. Cost of capital is kind of a nebulous term. I generally just assume it's like 5%, 10%, right? Just like a ballpark number. And clearly Apple passes this with flying colors. It's generating a ton of value. This is kind of my framework for analyzing a stock. I think I'm going to do a lot more of these videos in the future when I'm interested in the stock and I want to do a fundamental analysis. All right, cool. So thank you for watching, and see you next time.